So, what does it all mean? What do all these charts actually mean, and what is the purpose of why we want to look at them in the first place? Well, first of all, we're looking for high probability, low risk trades. In other words, when do we have an idea that there is a pretty high probability that a price is about to move, and that therefore reduces our risks? Now, what we're going to look at when we look at these charts are all sorts of different types, but I'm going to focus on the ones I like and the ones which I think are simple enough for us to actually make good profits from. Why do we do it? As I've already said, because we want to visualize. It's far easier when we're visualizing 100 stocks through their price charts to go through them in 10 minutes than it is to try and read 100 annual reports and so forth. Not only that, we've got to look at the indicators which come with price charts. And what these are, and I know it sounds foreboding, maths plus intuition, well actually what these indicators do is they remove the need to understand mathematics behind why a price is about to change. What they do is they just allow you to see on screen when a price is about to change. Now all this will be clear as we look at some examples. So let's kick on and move forward. Well, first and foremost I want to make some points very clear about charts. They're all about risk. What I mean by that is, first of all, don't worry whether the market is going to go up or down or what it's going to do. Worry about what you're going to do in response, and I'll show you what I mean with specific examples as we move forward. The mistake many private investors make is they're forever worrying about, is that stock going to go up? Is it going to go down? Whereas what they should be thinking is, if it goes up, I'm going to do this. If it goes down, I'm going to do this. Now, charts help us do that. The other thing we've got to remember is the key to money management, or any type of money management plan, is selecting with great care the stocks we want to be involved with. And that includes price confirmation to see, well, if I'm bullish on this stock, have I got confirmation from the price by it moving higher that indeed I'm right, I should be involved with this stock? Why is all this important? Well, because again, it reduces the risk of getting into bad trades. And you'll see some of these examples as I take you through them about how this works. But also, let's remember fewer trades. It's better to have fewer trades than it is to have losses. This again is where charts come in. So I just want to give you this kind of background as to why we're looking at all of this. Now, how are we going to do this if we had a systematic business plan? On the whole, I would suggest what we're looking for is any kind of stock which gives us some kind of expected return of about at least 30%. Now this means, and I'll again show you specific examples, what this means is we want stocks which we think will, whether it's over the space of a week or 2 weeks using spread betting, or whether it's over the space of a year because we're slightly more conservative and just by buying the shares, it's going to give us a return where we think we're going to get at least 30%. And that's one of our end targets. Point is, we have to be able to look at these charts and know, well, how do I know that a specific chart is likely to give me a 30% return? What is it about it that will give me that kind of clue? That's one of the things that we'll touch upon. But the point is, we must ignore that 30% expectation once we're in the trade. And the reason for this is, once you're in the trade, you don't know what the returns are going to be. If you don't know what the returns are going to be, even though you expect them to be 30%, be willing to be flexible enough to get out. Because if you hold on greedily, hoping and waiting and waiting and waiting, and all that happens is that the price falls and you become unstuck. You get into a problem. So, the returns are solely up to the market. Before we get in, we're expecting 30%. Once we're in, we ignore that. We get out at the best possible levels. Better to have some return than to have none at all. And your hope about what's going to happen to a share price, well, I'm afraid that simply does not move share prices, contrary to popular belief. Now, third point I want to make, as a prelude to this whole chapter on chart, you get out if you're wrong. What I mean by that is, we must mark on these charts specific points where we say, right, I know I am wrong at this point. If I am wrong, then I've got to get out. Even if you may be right in the long run. In other words, well, you know what, in 100 years, this stock will be up. That's not the point. What was your initial time frame? If your initial time frame was 1 year or 1 week or 2 weeks, and something's happened to the price to suggest you're wrong, and we'll show how on charts we mark this, then you get out. and you've got to plan for that retreat. You've got to decide before you get in on the price chart when you will know you are wrong. You calculate what the 20% loss price is, you mark it, and then you decide, well, should I be in this stock? Is this 20% loss acceptable? Is it going to be too easily hit? That's a problem with spread bettors. They look at that 20% loss and they go, well, I'll put my stop loss there. And guess what? Every day they get stopped out. By stopped out, what I mean is that it's a level at which they've said, I'll sell if the price drops to this. And inevitably it does because it's too close. The stock's too volatile. Again, I'll show you specific examples of what I mean. What you must never do is just blindly close your eyes and not put stop loss in, not put a level at which you're going to get out. That just does not make sense. And of course, the final point, if we're bearish, we completely get out of the market. Now let me close this part of charts being about risk with a few more clear points. Risk management is about cutting your losses. Pat Arbor said that. He was the former chairman of the Chicago Board of Trade, one of the largest derivatives exchanges in the world. If you remain in the comfort zone, John Najarian's point here, another great trader, and you stick to the game plan, then what makes this trade make sense is what you're asking. You've got to be within a level where you think, yep, it still makes sense. I'm in my comfort zone. It still makes sense. Are the odds stacked in my favour? Yes, I still think they are. How will I know if it's not worked out? What will the loss be at that point? These are all questions you've got to ask. Is it at the point where I think I'm wrong now, and you've got to ask that question beforehand and mark it on the price chart? Or it's still within my comfort zone. It's fine. George Soros put it this way: the key to long-term gains is the preservation of capital. The number of times Soros is wrong is actually quite extraordinary. But what he does to make that profit, make those 40% per annum returns year in, year out, is because he closes these positions whenever he is wrong. He says to himself, I was wrong. And that's that. And this is where charts, again, come in. We mark on where we know we'll be wrong and we get out at that point. They're very important, not just because of the profits they can give us, but the losses they stop us from facing. Now, another point Soros made. What's important is not whether you're right or wrong, but how much you make when you're right and how much you lose when you're wrong. If you make a mistake, you must respond immediately. That's why when I show you some of these charts, I'm going to show you looking at how you know you're wrong. And you might think, wait a minute, Alpesh, you're doing a heck of a lot on about losses and all of that. What about profits? I thought this was about making money. Well, guess what? Making money is actually about the losses you avoid. Protect your losses, and the gains, they really do take care of themselves. It's just the nature of the markets. Okay, let's move on. First of all, some key points I want to remember. Do not be involved in too many positions at once. It just leads to neglect. All that happens is you juggle too many balls in the air and you drop some. Next point. Primary objective is to maximize your expected gain. In other words, maximize profit. What that means is it's the probability that something's going to happen times the gain. Now, I know that sounds a little bit complicated and messy. We will return to it. But the point is, our probability for most of the chart patterns I'm going to show you is that 7 times out of 10 they're correct. So your probability is 7 out of 10. So if your gain is £100, then your expected gain is £70 because there's only a 7 in 10 chance that you're going to be right. I know it sounds a bit messy. Trust me, I'll go over it over and over again. Got to think in terms of probability. The chart patterns I'm going to show you are ones which I find work 7 times out of 10. The next point I want to make at this stage is you must predetermine your exit before you get into a stock. And the reason for this is once you're in, guess what? You're just going to absolutely loathe getting out. You're not going to think clearly. You're going to be attached to a stock. You're going to fall in love with it. That's why you must predetermine the exit point before your entry point. That's very, very important indeed. Final point on this chart. You must know why a position was open, why you expected, or what you expected it to make, how long you expected it to take to make that amount of money, and what the risk was. Make a note of those. What you need to do on a sheet of paper is have a note of all of those 4. Why did I open it? What did I expect to make? How long did I expect it to take? What was the risk? In other words, when will I know I'm wrong? And you can mark those points out on a chart. Again, I'll show you some examples in a second. That's the end of this small chapter. In the next chapter, we'll start looking at some specific examples.